So once again, good evening, everyone, and thank you so much for waiting. We'll start the session now. And as I said, my name is Yogesh, and this webinar is presented to you by Century Financial. And Century Financial is an investment consultants company, and we provide regular updates and strategies to our clients who want to be more updated about financial markets. We also draft a lot of portfolios and understand risk appetite for the clients and for the investors. And on those basis, whatever is the updated market trend and whatever are the latest investment trends, we present it to you. Uh, Today's webinar is about understanding the market trends from analysis to action. Today, we are going to understand about um, how the global events and how different events they change the market trends, and we'll see some very live examples because I'm online on a live trading platform where I will show you the impact of some of the significant events which has happened in the last few years, and how commodities or indices or currencies they have reacted on it. And this will clarify the fact that market trends always keep changing, and with the changing trends we have to update ourselves. How can we bring some market neutral strategies? And when I say market neutral strategies, without complicating anyone, very in very layman language, putting strategies which can reduce the impact of market fluctuations on your portfolio. Those kind of strategies we are going to talk about today. Um, this I want this to be a very interactive session. So you have your chat options next to you, and you can click on the chat option and you can ask me any questions regarding your investments. If I'm able to answer, I'll definitely reply you right now or by the end of the session. If I'm not able to answer that question, there's somebody from my team will definitely reach you out. We are located in Ema Square, so we are very much available. Anybody wants to come for a one-on-one session, you're most welcome. We'll teach you, train you, support you during your journey of investments. So, without further delay, please, if you want, you can use your chat option. Just try it out. If you can see or hear me properly, and if you can see my screen properly, just write a yes or a okay, and I think that will be enough for me to proceed further. Sometimes there are network related congestions. Don't worry about it. In case if you miss this session, a copy of this will be uploaded on YouTube. However, the benefits of the session is always that you can ask your questions live, and we can always discuss more about the financial markets. So we are going to discuss some portfolios as well today, and the strategies or the information today. What we are going to discuss. Please do not take this as any form of recommendation. This is just for your information. If you want to act on this, please talk to your risk managers. Financial markets are extremely risky, and the past performance do not indicate the future outlook also, and it does not dictate the future performance as well. So we are going to share a lot of information. We are going to talk a lot about. I think most of you have already said yes, we can hear you properly. So I'm just going to go and proceed with the session today. And as I said, we are going to talk some strategies, and I'm going to take you to the live platform right now, because understanding market trends is something which is really important, because there are global events which happens in financial markets. And global events, it kind of encompasses a wide range of occurrences, and I'm talking about natural disasters, pandemics, to political crisis, any major technological breakthrough. All of these collectively are global events, and this affect your investments, this affect financial markets as well. And when a significant event occurs, they have the potential to disrupt economies, they have the potential to disrupt industries. Like I will not go too far. COVID-19, it led to a widespread economic turmoil, and it kind of reshaped various sectors. The way we look at the world today has absolutely changed. I think this entire world now is divided into a pre-COVID and a post-COVID era. And then there are a lot of geopolitical factors. Like we look at a lot of geopolitical factors. There are political issues, territorial issues. Currently, we are witnessing a war between Israel and Palestine, and in 2018 we witnessed a much difficult trade war which was between US and China. And we have seen that these kind of events have pronounced effects on financial markets. It influences the stock prices. It impacts currency exchanges also. It impacts commodity prices also. And that is the reason that why I want to do a touch base on a live platform, so I can show you the live impact of this. I'm really going to share it right away, real quick. So what you're looking right now, guys, this is a live platform where trading happens, and currently you see the prices of different stocks, indices, commodities, and I'm going to show you the impact of the several events in last few years and how it affects. If you can see my screen properly, just a thumbs up or a yes would be sufficient, so I can proceed with this. Otherwise, I'll just zoom in a little more because I just want to make sure that everybody is able to see the screen. A yes or a okay or a thumbs up would be sufficient for me to check this out. All right. Okay. Perfect. 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 So, okay, a lot of you said yes. That's great. That's great. Perfect. So I can proceed with this. Now I'm going to show you an instrument which is traded a lot. So we are going to start with commodities first and see what events impact commodities, right? So let me start with gold. So here I close search gold versus US dollar, and I'm talking about gold as a commodity. And currently, if you see, the price of gold is $1,924 for 1 ounce of gold. 1 ounce is 31 grams, and this is dollar per ounce. Internationally, when we see the gold prices, that is how it appears. Dollars for 1 ounce of gold. 1 ounce is around 31.1 grams. So this is exactly how you are going to see gold prices in every platform, every global market platform. And now I'm going to open out uh, a price movement chart. And please make no mistake, we are not going to discuss too many heavy technical studies or technical analysis. We do separate sessions for it. But consider this as the pulse, price pulse of the gold as a commodity. How the prices have moved every single day, every single second. And currently, what you see here, I'm going to show you the price movement in last 2 to 3 years for gold. And this is really important that you must see this, because this right now is when we will start with um, 2021. 2020 is one of those areas where we can look at. But also I want to do a little touch base since 2016, so I can show you the impact on the gold prices. um, and if possible, oh, perfect. So I can show you something around 2008 when the global financial crisis happened. And please have a very closer look at this and tell me if you're not able to see this, because what I'm showing you right now, this is something which is really common. If you probably Google this chart, you will get it also. So it's not something extraordinary, but I'm going to explain you the very reason that why these prices have been so volatile, and slowly and gradually we'll reach to that point where we'll understand the role of fluctuations and how it impacts our portfolio, and then how we can employ some strategies which can reduce the impact of these fluctuations on our portfolio, right? So now what you see is a gold price chart of all these years, and I am currently looking at, and please use your chat options if you want to communicate any suggestions, any questions if you have, please do ask. So right now, let's say right here, this is where the financial crisis happened in 2008, 2007, 2008. And as you can see, since the very beginning of 2008, we have seen gold prices going up 700, $800 per ounce, $900 per ounce, and then eventually again coming down from $900 to 826. So this was one of the most important events, guys. After, so first thing which I want to highlight is the global financial crisis, which happened right here in 2008. And look at the impact in the gold prices, just shot up. Reason why? Because gold is considered a lot of times as a safe haven asset for the investors. If people are under distress, if investors are panicked and they have no direction where to invest, they seldom pick stocks. They mostly go for commodities, and especially they go for gold. A lot of investors in the past have been saying that whenever a major calamity or an event or a political event occurs, it impact the gold prices in a very positive manner, because most of the investors, they find that safety in the gold prices. So ideally what happens, they start getting rid of the stocks and they start investing heavily into gold. And I will show you this thing. So the first event which I showed you right here was global financial crisis, right? This is right here what had happened 2008. Had increased the gold prices, if you can see this. Second thing, if you see from 2009, now this is where you must see this, and I'm going to draw a very straight line here. From 2009 till 2011, if you see right here, I hope everybody can see this. Till 2012, gold prices have kind of moved higher. For consecutive 3 years, gold prices continue to move. What do you think was the reason? Because 2008 is when financial crisis happened, right? So we saw, so just to highlight this, something very interesting. So I'm just going to draw very small channels so you can also see the impact of this. So 2008 right here. Okay. These are the rises which we are looking at. So if you see 2008, the first one, we saw gold prices going up when the crisis happened. Then 2009 to 2012, gold prices have skyrocketed. And from where to where? From almost $800 per ounce to the highest $1,800 per ounce. In 3 years, gold went up by $1,000. What do you think was the reason? Can anybody tell me? Think about it. So recession happened, financial crisis happened, gold went up, and then it was in 2008, but between 2009 to 2012, we saw gold prices going from $800 up to $1,000, up to $1,800. So a jump of $1,000. What happened that particular time? So central banks, when they realize that the entire world is into recession, they slash down the interest rates. Which brings me to my next point, that while we are checking what sort of events can impact your investments, one was the global recession. Obviously, if a major credit event or a recession or a financial crisis occurs, it impacts stocks. It did go positive for the commodities. Why? Because when recession happened, the US central bank took a decision to print more currency and make loans cheaper to get. So they cut down the interest rates for loans, so everybody could borrow at a cheaper credit, at a cheaper interest rate. And at the same time, they continue to print more currency to inject into the financial system so that there is enough money circulated in the economy. And that was the reason why gold prices skyrocketed, because printing more currency made dollar weaker. and gold being valued against dollar and other currencies became much expensive, and it went more and more higher. So the idea is very simple. What happens is gold, which is valued against dollar, euro, pound, and when dollar was being printed more, the supply of dollar, it reduced the value of dollar, and the moment it reduced the value of dollar, gold became more expensive. So that was the idea why gold prices from 2009 to 2012 have been skyrocketing, if you see in the past. And that brings us to the point that the role of monetary policy in the prices of commodities and stocks play a very important role. Why I have opened this chart? Because soon you will realize that how monetary policy changes at various levels have actually brought a lot of a lot of movement in the market. Now, fast forward this, we move forward with uh, 2013, where we saw 2013, 2014, and then 2015 is where you see the prices started coming down, because this printing of more currencies and injection of more and more dollars into the economy. After the central bank realized that markets are recovering back and we are getting back to the same levels, they started cutting down this printing of currency, and they started talking about a possibility of increase in interest rates. So obviously no country wants inflation be too high. So to control that, the central bank started talking about the possibility of increasing interest rates, and at the same time they started talking about that, okay, we have printed enough currency now, and now we should cut back on this, which means the dollar value would get stronger and gold prices would start coming down. As a result, what we have seen between 2013 to 2015, if you see how gold prices have dropped completely all the way from $1,800 eventually to come down to 1,000, so fell down by 800. Then came 2016 when Donald Trump became the president. And then you will see throughout this, when Donald Trump became the president, if you see in 2016 to 2017, gold prices higher. Then again in 2018, if you see, we saw gold prices going higher because US and China were into a trade war. So if you see right here, until entire 2018 we saw trade war, and then when the trade war got resolved, gold prices dropped again. Then in 2019 and again 2020, as we see that because of the pandemic, the gold prices started going higher because investors were under so much panic. Gold prices went all the way up right here, if you see, all the way higher from $1,260 to 2,040, a jump of $800. And eventually in 2021, when vaccines were found out and vaccines were being distributed, we saw gold prices again coming down all the way to 1690. And then inflation started growing higher because during the pandemic, global central banks again started printing more currency. And by the time 2022 happened, the inflation was so high that the central bank decided to increase interest rates instead of cutting it down to control inflation. So increasing interest rates means making loans more expensive, which means the dollar becomes more stronger, and gold prices, they again started getting weaker. So you see this big downfall in gold throughout 2022. And then again the Russia Ukraine war, and followed by currently what we have seen 2023 onwards, we have again seen gold prices moving higher right here, if you see. And this is a very long term chart which we are seeing, and see the impact of these events, how the upsides and the downsides have been. And now if I move on to what has happened in last few days, I'll tell you in last 10 days how gold prices have actually moved. Or let me tell you, yeah, so if I were to show you a chart of how gold prices actually have moved in last few days, this was something which was in September, when the central bank decided that they will keep the interest rates higher to control inflation. And we saw gold prices actually coming down right here. This was somewhere around in September, and then October started, while the prices were right here, if you see. And then there is this big gap where gold prices have just again started going higher. And this is the increase when Israel and Palestine war was announced. And gold prices eventually from 1818, it went all the way to 1920. $100 jump in last 6 days is where gold currently stands, right? So this is the impact of the market events. This is the impact of the events which happen, whether it is a central bank policy or it's a pandemic, it's a financial crisis. It impacts your portfolio. I just showed you the impact on gold. If we were to see similar events, and how it this has impacted US stock market, S&P 500 for example. So now I go to the same duration since 2008. And if you see the same thing, I'm going to draw a channel to show you. 2008, the moment crisis recession start, we saw US stock market crashing right here, if you see. And then 2009, when central bank announced that we are going to print more currency and we are going to keep loans less expensive and very cheap. So that time it boosted up the markets. It increased the prices of gold because dollar became less in value, and it pushed stock markets higher because loans were cheaper and more currency was being printed. So from 2009 until 2015, I think, or I would say until the next 10 years, the stock markets continue to go higher. If you see right here, barring a few small declines, just giving you an idea. See, look at this rally from 2008 till 2018. 10 years, we enjoyed a huge stock market jump. S&P from $800 went all the way to $2,800. In 2018, when trade wars started between US and China, we saw a slight decline here. And then when the trade war was resolved, we saw slight increase. And then look at this particular time right here. I'm just going to make a horizontal line. This is a fall during the pandemic. And then again, if you see the rise just after that fall, which was very dramatic, that markets just recovered eventually, immediately after the fall. And a bigger rally was because of the tech stocks. All the technology stocks went high during the lockdown. And then what we see later on is the impact of higher interest rate, which has been continuing since so many years, last 2 years now. And markets have been on the downside, and then it has slightly moved higher when Fed announced that they might pause the rate hike. And this market has also been impacted by the constant Russia Ukraine war situations, Germany being into recession, and the negative global sentiment has also affected. So these kind of things, guys, this is really important to understand. These kind of new central bank decisions, it impacts stocks, it impacts currencies, it impacts cryptocurrencies. I mean, cryptocurrencies are again a bit more volatile, but it does impact a lot of other movements as well. Now I'm going to share some strategies with you, because now you understand that how this ups and downs can impact your portfolio. So how would you actually try to prepare yourself against these things? So just going to share a quick portfolio where you can diversify also. But as I said, that this will be for information purpose only. And please go through these a few strategies. I don't want to stress this session too much, but then I just want to share real quick the strategies which you can look into. Right here. And Yeah. So first strategy. So first thing we are going to see is a very common thing: high dividend yielding stocks. So there are two kinds of stocks. One is growth, which are basically the tech companies which do not give any dividends, and then there are a few companies which gives you decent amount of dividend, but they don't move too much, less volatile, income giving. And I think this has been the need of the hour. A lot of investors now choose quality companies, fixed income companies. They don't want to take too much chances with the tech stocks, also because the risk is slightly higher in the tech companies. And that is why, if you see, I'm sharing a portfolio with you. This is high dividend yielding stocks, and we are looking at the companies right here. Energy Transfer LP, the dividend yield is around 9%, and the stock costs $13. And if you see, the compounded annual growth rate of the earnings is around 3%. Most important part is that a lot of these companies, sometimes the dividend yield, if you see, is extremely high. Simon Property Group, for example, 7% dividend yield. Fifth Third Bancorp, 5.7% dividend yield. Health Peak Properties, 6.8%, and Annaly Capital Management, 14% dividend yield. To give you some idea about these stocks, they are from pipelines, retail, banks, healthcare, and then there is mortgage. Annaly Capital Management, for example, mostly has properties which are government properties, and their major exposure is into government properties. So it's one of the companies which you can look into and gives you a 14% dividend. The last price was around $18. And again, as I said, the net sales annual growth rate is around 1.17%. This is important. Why? Because during this time, we do not really want uh, to expose ourselves into too much riskier stocks. If there is a fixed income stock which you can get, I think a part of your portfolio should definitely be diversified into these companies. So once again, just to show you a few high dividend yielding stocks right here: Energy Transfer, Simon Property, Fifth Third Bancorp, Health Peak Properties, and Annaly Capital Management. If you see, none of these areas are technology. Most of these are consumer utilities, pipe like energy, real estate, banks, healthcare, mortgage, real estate, and all of that. And the prices are very less volatile, but a fixed income, as you can see, is really there. So I think that makes a lot of difference. Moving on, next strategy which you can apply, and this all is a mode of diversification. The worst mistake a lot of investors they do is just expose themselves to one asset class only. Not preferred at this moment, because there's a lot of volatility in the market. So you expose yourself into every sector, but just be disciplined and smart enough to pick the right option. So there you are having some dividend yielding stocks. Now, let me show you right here another strategy which can be looked into. So there is one stocks, and then there is some bonds portfolio. Bond is important because the bond yields are actually very good currently, and because the government bond yields are around 4.7% to 5%. The corporate bond yields, the investment grades, those bonds which have a less credit risk or have a very less risk of being bankrupt, their yields are around 8.7%, 7%, 8%. You are getting these bonds where you will get your capital back if there is no credit event, if there is no bankruptcy. But then look at these companies which you are looking at who have issued bonds: Bank of America, HSBC, Citibank, Standard Chartered, Society General, SocGen, Barclays. So all of these companies, their ratings are also given, and a lot of these bonds, their maturity is perpetual or callable. So they will mature only on specific dates. And when I say mature, which means that they can be called off by the issuer on these dates. Otherwise, most of them, the maturity is perpetual, it's lifelong. So you are getting 8%, 8.7% yield just by loaning this money to these bigger companies. And that's why a lot of investors have diversified their portfolio into dividend stocks, tech companies, government bonds, and now what you see is the corporate bonds, which is investment grades. That's where you have to diversify your risk also. Because these asset classes are completely separate from each other, and that's where the key diversification happens, where correlations are almost negative, right? Another strategy which where we are very actively looking at, and you can check in your portfolio also. So now we understood about corporate bonds, how we can employ. We looked at some fixed income stocks also, something which you can also look at, and this is a trade, basically a trade between uh, two very similar asset classes. And currently we just not diversify only into asset classes, we should also diversify into different economies. So US is one, Europe is another. So this one which I'm sharing it with you, this is between a German bond and an Italian bond, and we are buying German bonds and we are short selling Italian bonds. And for those people who don't understand short selling, we can definitely have a one-on-one session and I can explain. Short selling basically means that you can borrow the bond from your broker and sell it in the market, and if the price drops, you buy it at a cheaper price, keep the price difference with you, which is your profit, and give back bond to the broker. So like this, you can do this in the platforms. So the flyer is based on, as you can see, I'm just going to read this out so that you can also understand. So this is called a pair trade or a spread trade. And spread trade means the difference between the prices of two instruments. So if I say the spread between A and B is $2, which means A will be a price of 4, B would be a price of 2. So the price difference between two is $2, which is called the spread trade. Similarly, this flyer is based on historically observed spread, which means the price difference between German bonds and Italian bonds. And they have seen that historically Italian bond yields have tended to stay higher than its northern peers, including that of Germany. So, because Italy was hit the worst in pandemic, and they are going through a big political risk, they have a very high public debt to GDP ratio. So the expectation from Italian bond yields is very high. Investors want more return from those bonds because the risk is too high, right? So that impacts the prices also. In addition, we have seen in case of Germany right now, the as compared to Italian bonds, the yields are not too high, right? So the latest jump in Italian bond yield was due to the government announcing plans for a higher budget deficit. When yields of a bond go higher, we are expecting prices on the downside. So Italian bonds is a short sell according to the strategy, while we buy German bonds, and the price difference between both is already too high, and it's expected to go even higher. So currently, if we see, there is a lot of political pressure on Italy, and currently, when we see the difference between the German bond prices and the Italian bond prices, it is around $16.50. Normally, this difference is around $26 or $25. So as you can see in the chart, this is where, let me just zoom this in for you. This is where the current price difference is, and it should be somewhere around here, 25 or 26. So that's why you buy German bond and you short sell the Italian bond and expect that either German bonds are going to go up or Italian bond prices are going to go down, but either way, this price difference will increase. This is called market neutral strategy, or it is also called a statistical arbitrage. Again, guys, I do not expect everybody to understand this right away. That's why when we do these webinars, this is just to introduce what can be done. As far as the execution of the strategy is concerned, it's very easy. You can do this with a click of a button on your platform, and we will explain it to you what are the risks involved in this and what is the benefit. both ways, because it's not a risk free strategy. Of course there's a risk involved, and market speculative the speculative markets always have that kind of a risk. So please talk to us, discuss with us, and we'll explain you further how these strategies actually work out. So we understood a dividend income strategy, we understood a corporate bond strategy, and we just showed you how you can exploit the difference between German and Italian bonds and take a strategy on that. Now I'm going to show you something very seasonal, and that is called price action analysis. And this happens especially during the time of earnings, because earnings is one of those times where all these companies and all these stocks, they come up with their results. Just 1 second, guys. Sorry. Yeah. So they come up with normally with their earnings and with the results. So you can take in basically you can have the advantage where if you predict the earnings of a stock is going to be positive and up to the Wall Street expectations, the stock can skyrocket. To give you a real quick idea of how volatile markets can be, I'm going to show you this quick chart of Nvidia, because Nvidia is a graphic chips manufacturer, and last time when their earnings report came out, let me show you the impact on the stock. This was last quarter, August. Look at this big gap right here. I don't know how many of you can see this. You see this gap. So markets closed on 24th April at a price of $305. And after the market closed, Nvidia declared their earnings result for the quarter. And they were so exceptional and so good that the next day, the stock, which closed at $300 last night, went up all the way to $386. $86 jump in one day because of a positive earnings. That's how important earnings are for a stock. So we came up with a strategy called price action analysis. And price action analysis is actually something which is really good. I mean, it gives you a very good information. And real quick, let me share this right now with you. So real quick, this is price action analysis. And what it does, again, as a strategy, there are a lot of these companies which are going to come up with the earnings, right? So I'm just going to take one, let's say Bank of America. So current price is $26, right? The target price is $33 from Bloomberg. Earnings 17th October, which is today. UAE time 2:45. Now, if you see this, this was today. Great. So we can check the results also. The probability of an earnings beat was 70%. So which means there was a 70% chance that Bank of America's earnings are going to come better than expected from the Wall Street. And one day implied move during the earnings was around 4.5%. So price could go up by 4.5% or down by 4.5%, depending on how earnings come. An average absolute move after the earnings is around 1%. Historically, we have seen maximum gain in last 10 years during these earnings is around 3%, and maximum loss is around 2.9. And if you buy this stock during the earnings and hold on to it for say 7 days, the return could be around 2.6%. If you hold it for 30 days, it could be around 5.9%. So basically, the idea behind putting a price action analysis is to go back 10 years and see the impact that whenever a stock comes up with the earnings and the results, what happens to its stock price after the earnings come out? Is it positive on an average? Is it negative? What is the probability of an earnings beat? Do we expect Bank of America to come up with positive earnings? So this is where we have to understand. Look at this. So today we are seeing this flyer. It says 17th October, Bank of America right here. and the probability of earnings beat is 70%, right? Now, if we see today what has happened to Bank of America, I think they have already declared their earnings, because this was supposed to be at 245. So I'm also going to check this out today with you. Bank of America. Sorry, one second. Let me stop this and go back to the live platform right here. See, so I'm going to go Bank of America and find out. So if you see today, right here, the stock is up by 2.5%. And Bank of America has given positive earnings today. So the profit has gone up by 10%, and they have reported an annual 10% jump. Their earnings are good, net income has gone better, interest income is higher, they have beat the forecast. And that's what the flyer was saying at that 245 when the earnings come out, that there was a 70% chance that Bank of America is going to beat the earnings estimate, and it did. So again, there is no 100% that it's going to, but a probability is good enough to take a trade rather than a complete speculation. That's where the strategy comes in. Every trader I have met, I have seen in last 15 years, they follow a discipline and they follow the numbers. Besides fundamentals, numbers are also really important. You have to do your research right. You don't need a platform which charges you less. Pay more charges, but connect with people who are able to provide you a good in-house research. And at the end of the day, it always will be a speculative market. So make up your mind that when you are entering into financial markets, and the moment you buy a stock or a bond or a commodity, you expose yourself to lose money in the market if the call doesn't go right. And that's why you need the best probability. That's why you need to be very well versed with your numbers. You need to do more research to find out that why should I be investing into this. There are a lot of ways people can speculate. They can gamble in these platforms, take high leverage. Only a disciplined trader and a disciplined investor and a patient person can do this properly. So that's why a higher percentage of people who speculate and day trade, they lose money in the market, because they are not disciplined, they are not diversifying, they don't have the numbers right. And that's why you need to be in sync with your risk consultants, talk to them, ask them questions, and I think that's the way to go about it, right? So there are a lot of these strategies, guys. Let's connect one on one. We are based in Emar Square, and this is something which we always, because you have attended this webinar, next few sessions, you can come to our office and talk to us, and it's going to be absolutely free of cost. There is no commitment. You don't have to open any accounts or fund any accounts. You can just come, enjoy a cup of coffee with us, and discuss these strategies with us and see if this fits into your portfolio, right? That's all I'm saying. So once again, guys, thank you so much, all of you. I see a lot of people around here. Some of you have questions. Can we get this demo account? Absolutely, you can get this demo account. The practice account is always the best way to test these strategies. To talk to your RMs who have suggested this webinar to you, and they will immediately give you a demo account where you can see the live prices on your own. And if you want to understand how to use this demo account, I'm available for a one-on-one session. Just book your sessions and we'll be definitely available and do everything we can to support, teach, and train you. Right? So once again, guys, thank you so much for your time. I would definitely be happy to hold a one-on-one session, as I said. Please talk to your RMs and let us know if you're interested in one. We'll meet you next week with a different topic. If you liked our webinar, please go on Century Financial Google reviews. Give us a positive feedback. This is something which we do to spread more and more awareness among the investors. And eventually, the idea is that you understand the market trends and you trade safe, diversify enough, and be aware about what other strategies can be used. So once again, thank you so much for your time. My name is Yogesh. We'll see you next week with a different topic, same time. And thank you so much. You have a good night.